Well, hi everybody and welcome. Today we're going to be looking at determining net sales, and we're going to have to look at returns and allowances, credit card fees, sales terms, which would also include sales discounts. We'll be covering the gross method and the net method for recording this. So let's go ahead and get started here. Net sales. Net sales would include sales less sales returns and allowances, credit card fees, sometimes called credit card discounts, and sales discounts, which are really prompt payment discounts based on sales terms. So when you see the words net sales, what it means is the sales less all of these things, so the end result or the net amount of sales that we get to keep. Sales returns are not an expense. They are also not put back into sales as a reduction. Credit card fees are not considered an expense, so you're not going to see something like credit card fees expense, but rather it should come right off of your sales figure to arrive at net sales. And then discounts for prompt payment are also viewed as a reduction in sales instead of another expense. So when we're determining sales, net sales, we start off with sales, as you see here, and then we subtract the sales returns and allowances. We also subtract any credit card fees that we might incur, and then we subtract the sales discounts as well to arrive at net sales revenue. Now let's first talk briefly about sales returns and allowances. With sales returns and allowances, it has two parts, sales returns and of course sales allowances. Sometimes sales returns and allowances are put into the same account, but they're really kind of two different things. Sales returns would be when the customer returns the goods that they have purchased. And a sales allowance is where the customer keeps the goods, but we offer the seller offers a price reduction after the sale is made. So for example, if you buy a new refrigerator and you get it home and it's being installed and you notice on one side of it it's got a scratch, it really doesn't show but it's still scratched, and you think to yourself, man, this is a brand new refrigerator, I should return it. If you call the store, when you talk to them, they may say, hey, listen, how about you keeping the refrigerator and we will just reduce the price a little bit. We'll give you a sales allowance. And so that's what that's all about, where the customer is afforded an allowance in the selling price, in the purchase price, I should say, and they go ahead and keep the goods. So in accounting for these, here's the original sale. Let's say that we have an original sale of $300 and the cost of goods sold was $200. We record the sale. We're debiting cash. We're crediting sales revenue for the $300. And then we record the cost of goods sold by debiting cost of goods sold and crediting merchandise inventory. And then if the goods are returned, what's going to happen is we're going to sort of reverse out these entries. But instead of taking the amount to sales revenue and reducing sales revenue with a debit, we like to keep track of how much our sales returns and allowances are. So instead of debiting sales, we're going to debit sales returns and allowances. And then of course we're going to credit cash because we're giving the cash back to the customer. And then we're going to also, hopefully these goods can be sold, so we're putting them back into merchandise inventory, and we are crediting cost of goods sold. So to put them back in merchandise inventory, we debit the merchandise inventory and we credit cost of goods sold. Now for sales allowances, it's just a little bit different. Let's say that the original sale's $800, goods cost $600. We go ahead and record the sale as we normally do, which is sort of a two-part entry as you recall from your more basic accounting. We record the sale first by debiting cash. In this case, it's a cash sale. If it was on account, we would debit accounts receivable. So we're going to debit cash, we're going to credit sales revenue, and then we're also going to record the cost of goods sold, which is going to be a debit to cost of goods sold and a credit to merchandise inventory to take it out of our inventory. Now let's say the customer has a complaint and it's legitimate and we want to give them some allowance for this. Maybe the product is scratched, dented, whatever, and we're not going to take the product back, but we are going to give them a discount. So what we're going to do is we're going to debit, instead of debiting sales, we're going to debit sales returns and allowances for $150, the amount of the allowance, and we're going to credit cash for the amount that we give them for the allowance. Now let's talk about credit card fees. When a company takes a credit card, let's say that they make an $1,000 sale on a credit card. Customer hands over a credit card and they're going to put it on the credit card. The merchant that's making the sale is going to have to pay a fee for that. They're going to have to pay a fee to the credit card company. Sometimes they call this a discount because they're not going to get the full $1,000. In this case, they're going to have to pay a fee of 3% to the credit card company. So let's see, if it's a $1,000 sale and we got a 3% fee, that 3% is going to equal $30. So not a tiny amount, not a tiny amount here. So we need to record the sale and take into consideration this credit card fee or credit card discount. Now, one way of doing it, and this is a way that's presented in many, many textbooks, such as if you're studying in financial accounting out of Libby and Short or Wild, then it's going to be presented in this way. So what happens is, I guess in theory, we would only get the let's see, 1,000 minus the $30 credit card fee. So that gives us $970 of cash that we're going to get. So and notice that we don't take it to accounts receivable. We take this to cash. And the reason we record it as cash is because when a company sells on credit card, they receive that cash immediately, like that night. Most of the time, the credit card proceeds go into the bank before their cash sales go into the bank. So instead of debiting credit card, or credit card receivable or accounts receivable, we take it right to cash. So we're going to debit cash. And I guess in theory, we would debit it for the amount that we received, which is $970. And then we're also going to debit the credit card fee, credit card fees, and some may call this discounts, credit card discount for $30. And then we're going to credit the sales revenue for the $1,000. So that's what we would do. Now, this is great, except that nowadays, with the various cards that we have out there in the marketplace and in the hands of consumers, if we've made a deal with our credit card company for a 3% charge, if a customer brings in one of those cashback cards or a mileage plus card or anything, the percentage is going to be higher. and we as a merchant have no idea how much it's really going to be. So, I mean, this is a great textbook example, but in the real world, what companies do is they just go ahead and record the cash sale. So they're going to debit cash for the whole amount of the sale, which is in this case $1,000, and we're going to credit the sales revenue for the $1,000. And when this money is put into our bank account, lo and behold, it's going to be for the whole amount, just like we see here. It's going to be for the whole amount. And then what credit card companies do is at the end of the month, they tally up how much the fees are. And let's assume that our credit card company has tallied up all the fees, and lo and behold, all of them for all of the credit card sales we make total $4,500 for the whole month. Well, then what the company will do, they'll see this on their bank statement, and so what they're going to do is they're going to debit credit card fees, and you might think this is an expense, but again, it's not. It's a reduction in sales to arrive at net sales. And then sometimes this is called discounts, or discount, and that's the $4,500 for all of the credit cards for the whole month, all the credit card sales for the whole month, and then they will take this out of our bank account, so we're going to credit cash for the same amount, $4,500. Now, as we go through this, you'll notice I'm using debit and credit entries pretty freely. And that's because by this point, anybody that's looking at this topic probably knows how to do debit and credit entries. If you don't know how to do debit and credit entries, you can probably follow along pretty well and just use some common sense, like, what's adding and what's subtracting and so forth. Now, I should also indicate that for this example, as you see here, I'm not including the cost of goods sold part of the entry. I'm not including the cost of goods sold part of the entry because it would just complicate matters, and it's really not pertinent to what we're doing here. But certainly, if I was using the perpetual inventory system, I would be including the cost of goods sold entry for these. But just to simplify the presentation, I left those out. Now let's talk about sales discounts, a whole new topic, sales discounts. And what you may think when you think of sales discounts is, the company wants to sell more products, so they're discounting the products, but it actually isn't that at all. Instead, sales discounts, what are called sales discounts in business and in accounting, are prompt payment discounts. And they have to do with something called sales terms. Sales terms. You see this here. Now, what happens is companies will sell product, and as they sell product on account, they indicate to their customer, when they expect payment. So they might say something like net 30, which means the total amount of the invoice is due and payable after 30 days, or net 10. The whole amount of the invoice is due in 10 days. Or they might have terms that look something like this. Now, this is highly abbreviated, which is pretty popular these days to abbreviate these things. And that's because most people that are looking at this know what the abbreviations mean. But what this means is 2% if paid within 10 days. And if you miss paying it in 10 days, you got to pay the full amount, the net amount of the invoice, the full amount of the invoice, which is due in 30 days. And these terms can be, just about anything. Here's another one. 3%, so 315 and 60 means 3% discount if paid within 15 days, where the full amount of the invoice, the net amount of the invoice, is due in 60 days. Now, these terms up here are pretty popular. The net 30 days, net 10 days. This is pretty popular too. 210 net 30, meaning a 2% discount is afforded the customer if they pay within 10 days. Otherwise, they have to pay the full amount in 30 days. And you may ask yourself, listen, does it make sense to take a little measly 2% discount? If we're borrowing money at, say, 6%, does it make sense to do this? Well, let's take a look at that. Let's take a look at that, shall we? Let's say that we've got a $10,000 sale, and and we're wondering if our customer will take us up on our terms of 210 net 30. And let's assume that our customer, and we have no real way of knowing this, but let's say that our customer is borrowing at a percent, say they're borrowing at, say, 10% per year. So they're at 10% interest rate, I should say. So they're borrowing at 10%, And this is an interest rate. And the reason I call it a rate instead of just a percentage is it's a rate of interest for 1 year. Now this over here, this 210, so it's going to be a 2% discount if paid in 10 days, or the full amount or the net amount is due if it's paid in 30 days. But this is not a rate. This is an actual discount. This is a discount. And when you think of it, it's a discount to pay early. Now let's do a little bit of a timeline here to see how early this would be for. So how much earlier you have to pay it. So at the purchase date, let's call that time 0. And then you can pay this thing in 10 days. And if you pay it in 10 days, you get the 2%. Now, if you miss paying it in 10 days and instead you pay it in 30 days, you get no discount. So you get this discount for paying how many days early? 30 minus 10 is 20 days. You're paying 20 days early. 20 days early. So for paying 20 days early, you get 10%. Now, businesses that are, buying on credit, a lot of their vendors will afford them this 210 net 30. And so as time goes on, just about every day, they're taking a discount of one sort or another. And so it becomes a question of, okay, if you're getting a 2% discount for 20 days, if we annualize that, what's the annual rate? Well, if we take, let's see, this 365 days divided by 20 days, how many 20-day periods are there in a year? So how many 20-day periods are there? Well, as it turns out, there are how many? 18 in a quarter. 18 in a quarter 20-day periods. In a year. And if for each of these we get 2%, 2% times 18 and a quarter gives us an annualized rate of about 36.5%, about 36.5%. And so, it would be crazy for one of our customers not to take us up on the discount. And if they do not take their discount, you got to wonder, are they in financial distress? Why are they not taking advantage of this annualized rate of return of 36%? Now, this rate of interest, if you look at some of your textbooks like Libby and Short, if you're using that textbook, they use a more complicated method of calculating this. But the rate that they arrive at is pretty close to the 36.5%. Other textbooks use this same math to come up with this annualized rate. And if you're taking an accounting course, your instructor may require you to be able to calculate this. Okay, so now let's talk about recording these sales discounts. How do we record them? Well, let's assume we have a $1,000 sale with terms of 210 net 30, 2% if paid in 10 days, net amount due if paid in 30 days. And so we want to go ahead and record the sale. And as I've done before, I'm going to leave out the cost of goods sold entry for this area because it really doesn't. We're not really focusing on that so much. But let's go ahead and record the sale. So let's record the sale entry, and when we do, under what's called the gross method, we record what would be considered the gross amount of the invoice, the whole amount of the invoice. So we're going to go ahead and record accounts receivable for the full $1,000, for the full $1,000. And then we're going to credit sales revenue for the $1,000. So we're good. We're good. So we record the full amount. Now, if the customer pays within the 10 days, if they pay within the discount period, we're not going to get the full amount. We're only going to get, let's see, if paid within 10 days, the customer will take a $20 discount. Yeah, I guess 1,000 times 2% gives us a $20 discount. So they would take that discount, and so we're only going to get $980. So let's go ahead and record the cash we've got coming in of $980. Now the thing is, when they pay us the $980, it will pay off this entire $1,000 debt they have to us. And they will owe us nothing. So what we want to do to reflect that is to credit accounts receivable. Oh, hold on. I don't want to credit accounts receivable here because I think I've got another debit that's got to come into play. So I'm going to skip down a line and credit accounts receivable abbreviating a little bit to move along quicker for the full $1,000. Now this entry obviously doesn't balance, and we need another $20 debit right here. A debit, sort of a reduction of the amount that we got. And so where we take that is to sales discounts. And this would be, make a note of this, this is a reduction in our sales to arrive at net sales. So it's like a contra sales account. Your instructor or others in the know might call it a contra sales account because it's sort of grouped with sales, but it reduces the amount of sales, you see. So you'd reduce sales by this sales discounts to arrive at net sales. Now, what would happen if the customer misses the discount? Well, if the customer misses the discount, that's easy. All you've got to do is debit cash for the full amount that they pay, which is going to be the $1,000, and then we're going to credit accounts receivable for the same $1,000. There you go. Okay, so now what if the company, instead of using the gross method, they adopt the net method, Well, what happens here is the company will record not the full invoice amount, but instead the amount they feel they will get when the discount's taken. So the net amount after the discount. So, hold on, this is wrong. Sorry about that, net. They're going to record the net amount. So what we're going to do is record the accounts receivable for the net amount we're going to get, we think we're going to get, which is $980. And then we're going to credit sales revenue for the same amount, $980. There you go. Now, this makes it easy when the customer takes the discount, and most of our customers will be taking the discount. So what we're going to do there is we're going to debit cash for the $980 that we get paid, and we will also credit accounts receivable for the balance that's in the account, which is the $980. There you go. And so it's a pretty quick way of doing it, and works out pretty well. A lot of people don't like it because the amount we record as the sale is different than the invoice total. I can understand that. But the accounting is, theoretically, it's probably a little bit better, theoretically. Although most companies are still using this gross method for recording sales with sales discounts. So now what happens? What happens if the customer misses the discount? Well, no problem. If they miss the discount, we're going to get cash of the $1,000. And this will pay off the entire accounts receivable. But remember, the amount that we recorded is the $980. So we're going to credit $980. And then we've got this $20 here, $20 left. And what happens with this is by paying late, our customer has forfeited that discount. So we're going to call this sales discounts forfeited. Sales discounts forfeited. And there we go. So that's how we use the net method. So just to recap this then, we've got our net sales revenue, which would be sales less the sales returns and allowances, and we've talked about this and shown the accounting for that, so you should be at least pretty well versed with that. And then less credit card fees. Yeah, we've talked about that and how that's handled, so you should be pretty well versed with that. And then also less sales discounts. We've talked about that as well. So we subtract all of these items, and if we add them all up, they should be, what, $15,000 we subtract from $300,000 to get net sales. So if you look at financial statements issued by these big companies, when you look at their 10Ks on the SEC website and you look at their income statements, what you're going to see is net sales. It's going to show you net sales on the income statement. It never really says sales, but instead net sales. And now you know that net sales is sales less these three items. Well, that sort of takes us to the end of this presentation. Listen, I really appreciate you tuning in. If you like the video, please give it a thumbs up. Please. This is a little tiny YouTube channel, so any thumbs up we get really helps out. And consider subscribing to the channel. So thanks again. This is Mike Warner saying bye-bye from Miami, and we'll see you next time. Thank you now.